Hello everyone, welcome to Just Invest Today, and today we have a great video for you guys. Today we are talking about Mohnish Pabrai. He did a new interview with Wall Street Lab January 21st, and this interview was amazing. There's so many top ideas, top gems that he discussed. And you have to remember, it's super key to keep jamming these important value investing lessons in your mind, because this is just going to make you a better investor. So I'm going to go over the top things I took away from this interview. Before we get into this whole interview, this whole section, please like and subscribe to my channel. I'm providing you guys with so much new content. So let's get into this video right now. What is the difference between a great compounder and a growth stock? Between finding a growth stock at a value prices. So basically, Mohnish Pabrai goes into this whole spiel about capitalism is brutal sport. It's a dog-eat-dog world. Most companies won't last 2 decades. Most companies, new ventures won't even last 5 to 10 years. So when you honestly find a company that can last 5 to 10 years in this environment, it usually presents itself with a moat. And these moats, usually they're not like predicted. Like, these companies just run their business and they just over time develop a moat. He talked about Visa, MasterCard, American Express, like Costco, like those type of companies builded their moat over time. So these businesses have to be super resilient, and it's only a sliver of these businesses make it out of that mark of being growth companies with enduring moats. So when you think about Visa, MasterCard, American Express, Amazon, you gotta look at that closely and understand that that is very hard to do. So when actually Mohnish Pabrai looks at these businesses that actually endure and have these competitive advantages, he is not just looking at growth, because growth doesn't mean anything if this company is not going to be here for 5 to 10 years. It needs a moat. So he's looking at the durability of the moat more than the growth of the company. So he's looking at companies with high returns on capital, high returns on equity, just making sure that he sees a competitive advantage that the market is producing with these companies, and he still wants to pay a reasonable price when it comes to that. Costco is an amazing example of this. It's the low cost producer, and when you think about Costco, it's not going to go anywhere. You're going to see this growth for another 5 to 10 years. Like, who can take over Costco's durability, its moat of being the low cost producer on top of the amazing membership model? So think about companies like that when you're thinking about investing in different companies. Make sure they have a moat and make sure it's enduring and durable. The second question that was asked was, how many companies do you look at in a year? And Mohnish Pabrai talks about he looks at 100 of different companies, but when you're doing this, you want to like kind of discard the companies very fast, because you don't have a crazy amount of time. It can be because the growth is not there, it doesn't have a moat, you don't understand the business. There's a multitude of reasons why you kind of discard a company, and you kind of want to do that fast. Give it a 3 to 5 minute look. And then he asks a question about, when do you dig deeper? Like, what do you look at when to dig deeper? And he gives an example of a funeral service business that he actually looked at and he wanted to dig deeper because it was selling at a PE of 1 or 2, but it caught his eye because he understood the market, he understood the business, and he knew that it was a stable company or stable business model with reoccurring revenue, and it was selling at such a cheap price. So he wanted to look more into that company and see what it was going on with that company. So that's what you guys got to do. Sometimes when you're just looking through companies, you're just searching different businesses, sometimes something catches your eye, and that's how you build up your confidence. When you read more, when you learn more about different markets, different businesses, sometimes something will just catch your eye, it'll pop out, and that's why it's so important just to read a lot. Look at different publications, magazines, because sometimes you can be looking at a business and you see it's selling for a cheap price, or you're seeing something that the market doesn't see about that business that you see about it, because people are not looking at it in that aspect. So it's important to read a lot to look at different things. Also, he actually in this section discusses that how he missed buying Starbucks. An amazing business model that were just selling coffee at this higher price, and they were able to do this very efficiently. And when he saw them building up more stores in the same area and still attracting the same amount of customers, he saw this as an amazing business model, just an amazing business overall, but he didn't invest in it. And he said that was a huge mistake. So he's still learning his lessons. And one of the best Munger quotes is, "We're old too soon, wise too late." And then he goes into his two biggest mistakes. What's gradually sinking in is that a willingness to pay up and a willingness to hold, which is more important. Two mistakes: passing on wonderful businesses because they looked overpriced, but they were not. You could have paid 30 to 40x earnings and done very well. Selling businesses too early in its journey and it keeps on going is a big mistake. And this is a big mistake because it's super hard to find exceptional businesses with this durability, with extremely talented managers, with this amazing moat. It's so hard to find that, and you gotta buy it at a good price. So when you get all of that, you want to think of it like you're an owner and you want to keep it and hold on to it, because it's just so hard to keep finding these businesses again, and again if you sell it off. And he gives an example of Chrysler, and he had Fiat, and how Fiat spun off Ferrari, and he sold off Ferrari way too soon, and he missed like a 12x, a 13x. He missed on that because he just sold it too soon. He thought it was overvalued. And people miss out on those opportunities when they sell businesses too soon. So he's learning his lesson in that aspect. The next question is, are you bullish on the Chinese market? And this is super key because remember, we are invested in Alibaba. We have big positions in Alibaba and Tencent. Even Mohnish invested in Tencent. So let's see what he said about China. In general, China will keep rising. They are naturally entrepreneurial people who were artificially kept in a system. Now that the genie is out of the bottle, they are rising, getting more educated, better infrastructure, and will continue for a while. So Mohnish Pabrai is super bullish in China. He thinks China is becoming like the next superpower. They're going to increase their GDP. Remember, they're just second behind USA, so they have a long runway ahead of them. Mohnish Pabrai then gives you the key to value investing. He says that we don't have an informational edge. Everyone has the same information. Everyone reads the same article, same 10Ks. We don't have insider information, but value investors have an analytical edge. You come up with a different conclusion with all that information, and it gives us a different value of that business. So that's the edge that we got to use as a value investor. And on top of that, I would include, this is not what Mohnish Pabrai said, but this is what I'm saying, is that we can actually have a time frame edge. Like our psychology as small investors, we're able to hold on to these stocks for a long time without anyone judging us. And that's super important because a lot of these companies, they're going to take time to grow into their valuations. And with institutions, you have to produce results every month, every day. They're always checking up on you. People are coming into your fund, leaving your fund if you don't produce right away. So we have that time frame edge over a lot of institutions. So think about that also. And then he goes on to talk about Micron and what's the benefit of Micron, because think about this. Micron used to be a loser. It used to be a stock that was highly competitive. It was in a market where people were cutting prices. People were just doing anything to sell memory chips, and it was just like a commodity business. But now that Micron is in an amazing position, think about it. Now Micron's in an amazing position because it's only in an oligopoly. There's 3 players, and Micron's a part of that. And as e-commerce grows, as AI grows, intelligence, everything like that. Gives you an example of Amazon building a data center, and 30% of that goes to the memory players like Micron. That's an example of an advantage that we get, as he came up with a different conclusion than everyone else with the same information, because everyone remembered the pain of Micron 10 years ago when people were cutting prices, when it would go up 50% and then go back down 60%. People still have that pain in mind, so people didn't want to invest in Micron 2 to 3 years ago. But he used his mind differently and saw a different type of company that it's different now. So that's the advantages that we have as investors. He goes into more mistakes. Another big mistake is that we are not patient enough in the market. And this is surprising because he's been making so many moves, and he talks about we want to be super patient. We don't want to make a lot of moves. And in my opinion, when you make a lot of investing moves, there's more room to make mistakes because the company that you own right now and that you actually know when you research, and the company that you kind of know out there might not be just as good or might not be better than the company that you own that you might sell. So we're opening ourselves up to more mistakes to make in the market. So that's how I think he thinks about being patient, being calm. And then on top of that, it takes many years for the valuation to meet what the market talks about, what the market is giving it. So sometimes the market can be giving this company such a bad price, but you think the intrinsic value is way higher. So you got to be patient until that market reaches that intrinsic value or above it, and that can take years. So you have to be patient and understanding that and knowing how to think about investing. Actually, this interviewer asked him about people to clone, and he gives 2 people to clone, which I put on my clone list now. I'm looking more heavily into. I did before. I knew about this guy named Rob Vinali from RV Capital, and he's looking like a good investor. I think he's averaging like 19% already for like over 10 years. So that's a pretty good like sample size, and that's pretty good results for now. And then on top of that, he named this guy named Josh Tarasoff of Greenlee Lane Capital. Probably said his name wrong, but that's another investor that he gave to follow, and we can follow those people on Data Roma. And this is funny because if you look at it, soon as this interview came out, look at this new edition. The same 2 people Mohnish Pabrai named actually came on Data Roma right away. Robert Vinal and Josh Tarasoff, Greenlee Lane Capital and RV Capital. So people are listening up. These people from Data Roma are listening to these interviews. They're listening to what people are saying. So that's pretty funny. That's just kind of I don't think that's a coincidence that they just came up 2 new additions soon as this interview came out. So guys, please like this video, subscribe to my channel. I'm always providing you with so much new content, man. Thank you. Peace.